Good evening. It is my privilege to participate in the CTU Scholarly Inquiry Showcase. I would like to begin with sincere thanks to Dr. Kathleen and Dr. Lisa Ratliff-Villarreal. I also appreciate the faculty, scholars, doctoral students, and distinguished guests for their commitment to research and lifelong learning. I hope this presentation stimulates discussion about the future of artificial intelligence in auditing. Let me start with 3 familiar statements. First, drinking hot water cures a cold. Second, people who begin saving early always become wealthy. Third, AI always improves audit quality. We've heard similar advice from parents, grandparents, teachers, or colleagues. These ideas sound reasonable, but are they actually true? Or are they simply common beliefs that have never been scientifically tested? Suppose someone claims that drinking hot water cures a cold. As researchers, we don't simply accept or reject the claim. Instead, we transform it into a research question. We identify measurable variables, review existing literature, design an appropriate study, collect data, and analyze the evidence statistically. Only after completing this process can we determine whether the claim is supported. This illustrates the fundamental difference between personal belief and scientific evidence. Consider another common belief. People who start saving early always become wealthy. While early saving certainly offers advantages, wealth accumulation depends on many additional factors such as income, investment choices, market performance, inflation, and spending habits. Researchers account for these influences, often called confounding variables, before drawing conclusions. Good research helps us separate correlation from actual cause and effect relationships. Today, we hear frequent claims that artificial intelligence improves auditing. That may ultimately prove to be true, but from a research perspective, it remains a hypothesis until tested systematically. Instead of accepting the statement at face value, we ask measurable questions. Does AI improve fraud detection? Does it reduce audit time? Does it improve compliance monitoring? Those are research questions that can be investigated objectively using evidence rather than opinion. Everyday beliefs often originate from experience or intuition, but research converts those beliefs into testable hypotheses. We identify independent and dependent variables, apply an accepted research methodology, collect evidence, and compare our findings with prior scholarly work. My objective was not to promote AI, but rather to evaluate whether AI-driven technologies actually produce measurable improvements in internal auditing. The title of my research is From Spreadsheets to Smart Systems: Applying AI-Driven Fraud Detection in Manufacturing and Retail Internal Audits. The study examines how modern AI technologies can enhance fraud detection, strengthen internal controls, and improve continuous auditing in organizations that process very large transaction volumes. Spreadsheets have served accountants and auditors extremely well for decades. However, today's organizations generate millions of transactions across complex digital environments. Manufacturing and retail companies process purchasing, inventory, payroll, sales, and vendor transactions continuously. Manual spreadsheet analysis simply cannot keep pace with that level of complexity. This creates an opportunity for AI technologies to supplement, not replace, the work of professional auditors. I'll begin by describing the business problem, followed by the research purpose and questions. Next, I'll briefly discuss the theoretical foundations and relevant literature before explaining the research methodology. I'll then present the proposed AI framework, summarize the key findings, discuss future research opportunities, and conclude with the practical implications for the accounting profession. Organizations today are undergoing rapid digital transformation. Modern accounts payable systems, cloud-based ERP platforms, OCR technologies, and automated workflows have dramatically increased both transaction volumes and operational complexity. At the same time, fraud schemes have become increasingly sophisticated, and regulatory expectations continue to expand. While business technology has advanced rapidly, many traditional audit approaches remain periodic and sample-based. This widening gap between business complexity and audit capability is one of the primary motivations for this research. So far, we've discussed the changing business environment. The next question is whether fraud is truly a major organizational problem. The answer is yes. According to the Association of Certified Fraud Examiners, organizations lose approximately 5% of their annual revenue to occupational fraud. Beyond the direct financial losses, fraud also damages organizational reputation, increases regulatory scrutiny, and weakens stakeholder confidence. This naturally raises an important question for both researchers and practitioners. Can organizations detect fraud earlier and more effectively before these losses become significant? Rather than relying on a single source, I reviewed several major international studies. The ACFE estimates global fraud losses in the trillions of dollars annually. PwC reports that more than half of surveyed organizations experienced fraud within a 2-year period. KPMG highlights the rapidly increasing financial impact of payment fraud, while EY reports substantial growth in integrity-related incidents. Although the exact numbers differ, all of these independent studies point to the same conclusion. Fraud is widespread, costly, and continuing to grow. This reinforces why organizations need stronger and more proactive audit approaches. This slide summarizes the central problem addressed in my research. Traditional auditing remains valuable, but it is generally periodic, sample-based, reactive, and labor-intensive. In contrast, today's fraud environment is continuous, rapidly evolving, and operates across millions of transactions. As fraud techniques become more sophisticated, the gap between audit capability and fraud sophistication continues to widen. My research investigates whether artificial intelligence can help reduce that gap by providing continuous monitoring and earlier detection. Yes, I am hearing the question, why can't traditional auditing solve this problem? The answer is not that traditional auditing is ineffective. In fact, it remains the foundation of financial assurance and governance. The challenge is that traditional audit procedures were developed for a business environment where transaction volumes were much smaller and audits were performed periodically using sampling techniques. Today's organizations process millions of transactions continuously, and fraud schemes can develop much faster than a periodic audit cycle can detect them. As a result, traditional auditing alone cannot always provide timely identification of emerging risks. This is where artificial intelligence becomes valuable, not by replacing auditors, but by continuously monitoring large data populations and identifying unusual patterns for auditors to investigate using their professional judgment. Based on this problem, the purpose of the study becomes very clear. I am not attempting to replace professional auditors with artificial intelligence. Instead, I am investigating whether AI-driven technologies can strengthen fraud detection, improve compliance monitoring, enhance continuous auditing, and increase the effectiveness of internal controls within manufacturing and retail organizations. The emphasis is on supporting auditors so they can focus more on professional judgment and complex decision-making. One question often asked is why I specifically chose internal auditing. The answer is that internal auditors routinely examine financial transactions, internal controls, compliance activities, and operational risks. These functions generate enormous amounts of structured and unstructured data, making them ideal candidates for AI-assisted analysis. By moving from spreadsheet-based sampling to continuous AI-supported auditing, organizations have the opportunity to improve fraud detection while strengthening governance and overall assurance quality. These 4 research questions drive the entire study. First, can AI improve fraud detection accuracy? Second, can it reduce the time required to detect potential fraud? Third, can it expand audit coverage beyond traditional sampling techniques? And finally, can AI effectively support continuous auditing? Every stage of the methodology and every result presented later directly addresses one or more of these 4 research questions. Introducing the analytical framework used in the study. The first stage focuses on anomaly detection. Here, machine learning algorithms examine transaction data to identify unusual activities that deserve further attention. The second stage performs exception classification. Instead of simply flagging unusual transactions, AI helps explain why the anomaly occurred and categorizes it according to its potential risk. This 2-stage approach reduces unnecessary audit effort while helping auditors prioritize the most significant exceptions. Before discussing individual technologies, it is helpful to understand that artificial intelligence is not a single tool. Instead, it is a collection of complementary technologies working together. Throughout this study, I examined several AI components, including large language models, machine learning, natural language processing, and agentic AI. Each technology contributes differently to fraud detection, exception analysis, and audit decision support. The following slides briefly explain each of these technologies. In the AI audit model, structured financial data flows into machine learning and rule-based logic, while unstructured information such as emails, invoices, and contracts is analyzed using LLM and NLP techniques. Together, these signals are combined to identify high-risk transactions and provide more intelligent support for auditors' decision-making. Machine learning serves as the pattern recognition engine within the proposed framework. Instead of relying on manually created rules, machine learning identifies unusual transaction patterns by learning from historical data. It can detect duplicate payments, vendor anomalies, payroll irregularities, and other exceptions that may not be visible during manual review. Importantly, machine learning does not replace auditor judgment. Rather, it helps auditors focus their attention on the transactions most likely to require professional investigation. In the next section, I'll explain how natural language processing complements machine learning by analyzing text-based information. Natural language processing, or NLP, is the broader field of artificial intelligence that enables computers to understand, interpret, and generate human language. Large language models, or LLMs, are one advanced implementation of NLP. In other words, NLP is the technology or discipline, while LLMs are powerful AI models built using NLP techniques. In auditing, NLP allows systems to analyze unstructured information such as emails, contracts, invoices, management comments, and audit reports. This helps auditors identify inconsistencies, unusual language patterns, and potential fraud indicators that would be difficult to detect through numerical analysis alone. The next component is agentic AI, which represents the next generation of artificial intelligence. Unlike traditional AI that responds only when given a prompt, agentic AI can plan, reason, make decisions, and execute a sequence of tasks toward a defined objective with minimal human intervention. In an internal audit environment, an AI agent could continuously monitor transactions, identify unusual activities, gather supporting evidence, compare findings with company policies, prioritize risks, and even prepare a draft audit report for the auditor's review. Importantly, the final professional judgment remains with the auditor. Agentic AI enhances efficiency by acting as an intelligent audit assistant, not as a replacement for the auditor. The first theoretical foundation is agency theory, developed by Jensen and Meckling in 1976. The theory explains that managers and owners do not always have identical objectives. Because managers control day-to-day operations while shareholders own the business, conflicts of interest may arise. This creates information asymmetry and increases the need for monitoring. Internal auditing and AI-supported continuous monitoring help reduce these risks by providing greater transparency and accountability throughout the organization. The next theory is the well-known fraud triangle, introduced by Donald Cressy. It explains that fraud usually occurs when three conditions exist simultaneously: pressure, opportunity, and rationalization. Someone may experience financial pressure, find an opportunity because of weak internal controls, and then justify the fraudulent act. AI cannot eliminate personal pressure or rationalization, but it can significantly reduce opportunities by strengthening monitoring and detecting suspicious transactions much earlier. Continuous auditing theory represents a major shift from traditional periodic audits toward ongoing monitoring. Instead of waiting until month-end or year-end, technology enables organizations to evaluate transactions continuously as they occur. AI extends this concept by analyzing entire populations of transactions in real time, allowing auditors to identify risks much earlier and respond before problems become significant. Together, these theories provide the foundation for my research. Agency theory explains why monitoring is necessary. Fraud triangle theory explains why fraud occurs. Continuous auditing theory explains how technology enables real-time monitoring. Together, They support the use of AI as an effective tool for improving internal auditing. My literature review is organized into 5 major themes: fraud detection, continuous auditing, machine learning, agentic AI, and internal controls with governance. While prior research demonstrates growing interest in AI-enabled auditing, much of the existing work remains conceptual. There are relatively fewer studies demonstrating practical implementation within real organizational environments, which represents the research gap addressed in this study. Earlier research relied primarily on manual sampling, rule-based testing, and techniques such as Benford's law. While these methods remain useful, they often generate false positives and identify fraud only after significant losses have occurred. AI expands these capabilities by analyzing both structured and unstructured data, including emails, narratives, and contracts, allowing auditors to identify behavioral indicators and complex fraud schemes much earlier. Early continuous auditing research focused mainly on ERP-based scripts and predefined rules. Those systems required significant maintenance and were limited in adapting to changing business environments. AI changes this landscape by supporting dynamic monitoring, analyzing entire transaction populations continuously, and producing understandable explanations for exceptions instead of simply generating alerts. Machine learning has already demonstrated strong performance in areas such as anomaly detection, insolvency prediction, and risk classification. However, one limitation has been explainability. Auditors often understand that a transaction was flagged but not why. Combining machine learning with large language models addresses this challenge by producing clear, human-readable explanations that improve both transparency and auditor confidence. Traditional robotic process automation follows predefined steps. Agentic AI goes much further. It can plan, reason, use multiple tools, verify results, and complete complex workflows with minimal supervision. In auditing, an intelligent agent could detect an exception, retrieve supporting evidence, prepare documentation, and route recommendations to the auditor, significantly improving efficiency while preserving professional oversight. Internal control research has traditionally emphasized segregation of duties, approvals, and oversight based on the COSO framework. AI enhances these controls by providing real-time monitoring, automated three-way matching, and continuous testing of entire transaction populations. However, organizations must also establish governance over AI itself, including monitoring for bias, maintaining audit trails, and validating AI-generated outputs. After reviewing the literature, the next step was selecting an appropriate research methodology. This study uses a multiple case study design combined with a mixed methods approach. Quantitative analysis focuses on machine learning-based anomaly detection, while qualitative analysis uses LLM reasoning and documentary evidence. Triangulating these sources allows the study to evaluate AI performance within actual organizational audit engagements rather than laboratory simulations. After selecting the methodology, the next step is collecting the data. The study used multiple sources that internal auditors routinely examine, including ERP transactions, vendor records, compliance documents, internal audit reports, and contract files. The research focused on manufacturing and retail organizations because they process large transaction volumes and present higher fraud exposure. Importantly, all datasets were fully anonymized to preserve confidentiality while maintaining the integrity of the analysis. For those familiar with research formulas, please bear with me while I break this down for everyone else. We all know the formula for a straight line, y equals a plus bx. That is a simple linear regression with one independent variable, x. When you add more variables, it becomes a multiple regression. But in research papers, we use capital sigma as a fancy mathematical shorthand to add everything up. So that big sigma symbol on the slide, simply saying the same straight line formula and expanding it to neatly pack in all 8 of our independent variables at once. This is our anomaly detection model, the regression equation that estimates an anomaly score based on several predictor variables. Each coefficient measures the contribution of an individual risk factor. Rather than replacing auditor judgment, the model serves as an early warning system by identifying transactions that deserve closer professional review. The study analyzed approximately 15.5 million transactions, providing a sufficiently large dataset for machine learning analysis. Both independent variables representing risk drivers and the dependent anomaly score were evaluated to understand how different business conditions influence fraud risk. Every transaction receives an anomaly score generated by the model. A higher score indicates a greater probability that the transaction contains unusual characteristics requiring additional audit attention. Rather than examining every transaction manually, auditors can prioritize those with the highest risk scores, making the audit process both more efficient and more effective. The study included 10 internal audit engagements representing approximately 15.5 million transactions, more than 2,300 work paper pages, and over 1,400 documented exception narratives. Some transaction counts have been partially masked to protect confidentiality, but the scale of the data demonstrates that the framework was evaluated using substantial real-world audit information rather than simulated examples. How the regression results are interpreted. A positive coefficient indicates that as a particular predictor increases, the anomaly score also increases, making the transaction more likely to be flagged for audit review. Rather than treating every variable equally, the model quantifies the relative influence of each risk factor, allowing auditors to better understand why certain transactions receive higher risk scores. Once anomalies have been detected, the second stage begins. Instead of simply identifying unusual transactions, the classification model categorizes them into meaningful audit exceptions. This additional step helps auditors distinguish between normal business variations and transactions that warrant investigation, allowing resources to be directed toward the highest risk situations. To further illustrate how the classification model operates, combines information from structured financial data together with supporting contextual information to classify exceptions consistently. The objective is to move beyond simple detection toward intelligent risk prioritization, enabling auditors to respond more quickly and consistently. This example demonstrates how the model functions in practice. When multiple risk indicators occur together, the calculated anomaly score becomes sufficiently high to trigger escalation for further audit review. Importantly, the model does not conclude that fraud has occurred. Instead, it identifies transactions that deserve additional professional investigation by the audit team. The framework was evaluated using 10 internal audit engagements, approximately 15.5 million structured transactions, over 2,300 work paper pages, and more than 1,400 documented exception narratives. Multiple analytical techniques, including anomaly detection, pattern recognition, NLP review, and continuous monitoring, were integrated to strengthen the reliability of the findings through methodological triangulation. These are the key quantitative findings of the study. The AI framework reduced false positives by approximately 70%, achieved about 93% accuracy in contract analysis, reduced detection time from months to minutes, enabled 100% transaction coverage, and reduced manual compliance effort by approximately 40%. Collectively, these results suggest that AI has the potential to improve both audit efficiency and audit effectiveness. However, these technologies should be viewed as decision support tools that enhance professional judgment rather than replace the auditor. Let me illustrate how this model works in a real internal audit environment. Imagine a vendor payment enters the system. First, the transaction is evaluated using the anomaly detection model, and an anomaly score is calculated based on various risk factors. At this stage, the payment amount alone may not appear unusual. The next step is where natural language processing, or NLP, adds value. NLP reviews supporting documents such as emails, contracts, invoices, and approval narratives. In this example, the narrative states, "Approval waived due to urgency." While that statement may seem harmless, NLP recognizes it as a potential control exception because normal approval procedures were bypassed. The transaction is then classified and prioritized for the auditor's review. The auditor makes the final decision, but AI ensures that important exceptions are identified much earlier and more consistently. We identified several important qualitative benefits. Auditors reported improved consistency in fraud investigations, better documentation, and stronger explanations supporting audit conclusions. AI also reduced repetitive manual work, allowing auditors to devote more time to professional judgment, risk evaluation, and communication with management. These qualitative improvements are equally important because auditing is ultimately about making sound professional decisions, not simply processing data. Based on the findings, the AI-driven audit framework is not for relying on a single technology, but to integrate the structured financial data, machine learning, natural language processing, large language models, agentic AI, and continuous monitoring into one coordinated process. The framework supports auditors throughout the engagement, from identifying anomalies to documenting evidence and producing more timely audit recommendations. Organizations should view AI as a decision support technology rather than an automation project. Successful implementation requires strong governance, high-quality data, continuous model validation, and appropriate auditor training. AI can improve efficiency and coverage, but effective oversight remains essential to ensure reliable and ethical audit outcomes. Like any research, this study also identifies opportunities for future investigation. Additional studies could examine AI implementation across different industries, compare various machine learning models, evaluate emerging agentic AI capabilities, and investigate regulatory issues associated with AI-assisted auditing. Future research will continue to refine these technologies as both business environments and auditing standards evolve. If there is one message I would like everyone to remember, it is this: artificial intelligence is transforming auditing, but success depends on combining advanced technology with sound professional judgment. AI provides speed, consistency, and broader coverage, while auditors provide ethics, skepticism, experience, and accountability. The future of auditing will depend on this partnership between technology and human expertise. Now the time to list the references in APA formatting. For a deeper dive into the framework, these are excellent resources. Before closing, I would like to express my sincere appreciation to everyone who supported this research. I thank my colleagues, reviewers, faculty mentors, and professional organizations whose guidance contributed to this work. I am also grateful to the organizations that made data available for research while maintaining strict confidentiality requirements. Artificial intelligence will continue to evolve. The accounting profession will evolve with it. The organizations that succeed will not be those with the most technology, but those that combine technology with sound professional judgment. Thank you very much, and I welcome your questions.